So that's what we do at the Institute of International Monetary Research. We do monetary analysis. We study how money is created, how money is destroyed, because it can be destroyed, and which are the consequences of those two policies or actions in the economy. But may I start with something related to monetary economics, but not at the core of what we do, which is the presentation of the index of the euro performance. And why do we do this? Well, if you want to run a single monetary policy, which means a single interest rate to fit all the member states within the Eurozone, you want to have convergence all across the area. So rather than praising or criticizing the euro for political reasons or whichever reasons you may have, we just wanted to approach the question from a very empirical perspective. How has the euro performed since its inception in 1999? So we came out with this index. It was, in the beginning, it was Professor Peter Schwartz and myself writing a paper on it. And the Institute has been publishing this index in the last couple of years. And we intend to produce, to update the index every single year. So again, the expectation back in at the time when the euro was launched, in 1999, was that the member states within the Eurozone were going to become more homogeneous, more similar in terms of the macroeconomic cycle. So again, if you read through the Delors report at the time, just by launching the new currency would be completing the market union at the time. The discussions of the launch of the euro took place back in the 80s, and therefore will be enhancing convergence within the Eurozone. And that's precisely the aim at the time, and that was the expectation, the hope, if I may say. So it was very much the consensus at the time that even if the 11 countries at that time joining the Eurozone did not really form what it was considered an optimal currency area, they would become optimal over time by unifying the currency. Countries and economies will become closer to each other. That was the expectation. So what have we done in order to test for this hypothesis? Have the Eurozone economies become more convergent or similar, or have they not? Well, what we have done is to observe macroeconomic dispersion among all the nations that form the Eurozone with 12 macroeconomic indicators. What we've done is to calculate the standard deviation per indicator per year across the member states. And we have split up the information provided by these indicators into 4 categories or chapters. The first one is the business cycle. The second one is competitiveness. The third one is public finances. And the fourth one is monetary dispersion. Then what we did with all this information is for each chapter, we calculated the average of the standard deviation of each indicator. And then overall, we summed up all this information and produced the overall index of dispersion for the whole Eurozone, according to these 12 economic indicators. Which are they? Well, it is a wide range of indicators, as I said, split up in 4 categories. Regarding the business cycle, we chose the performance of each member state economy in terms of the real GDP growth, real GDP per capita, and unemployment rate. Regarding public finances, both the public deficit and public debt as a percentage of the GDP. As regards competitiveness, it was annual inflation rate as measured by the harmonized index of consumer prices, unit labor costs, and the real exchange rate. This, by far, is the most important one, the real exchange rate. And also we added monetary indicators, monetary dispersion. And we measure monetary dispersion according to 4 major indicators. The contribution of each member state economy to the overall growth of money in the Eurozone. That's how much money is created individually in Spain, Italy, and so on, and how much they contribute to the overall supply of money in the Eurozone. The other one is how much credit is given to the private sector as a percentage of the GDP, the current account balance of each member state, and finally, what is called target 2 balances. What target 2 balances measure is a tricky subject, but what they do measure approximately is the old current account position of each country plus flows of money coming in and moving out of the country. It's both. both of them. And as I said, what we produced is the standard deviation of all these indicators per country, per year, and produced the arithmetic average for them all. All right, so what about the results? Well, let me tell you some technicalities first. Just as a convention, we adopted 1999 as the base year for most of the indicators. That's the year when the euro was launched. And by no means we are implying here that the values of these indexes at the time of the launch of the euro showed an optimal situation for the Eurozone. We are not saying that. We're just taking 100 as a convention in order to measure, in order to have a standard to measure much better the changes that came afterwards. We then, as I said, calculated the standard deviation per indicator per year for the euro area changing composition. So that means the original 11 countries plus Greece in 2001, 2 more in 2007, and so on up to 19 countries since 2005 onwards. And these are the results of the index. First, we're going to display the positive news. Remember the expectations of the policymakers at the time. By launching a new currency, we're going to make the economies more similar to each other. So, according to the business cycle indicators, the unemployment rate, GDP per capita, and just GDP growth, indeed, the launch of the euro, you can tell in this line, how, let me tell you first how to read this chart. That is not that straightforward. Starting from 100 at the top, the higher the value, the further down the axis, the greater the dispersion will be. So that's bad news. Should the line go downwards, that means more dispersion. That's bad news in terms of dispersion. So as you can tell here, from 1999 to very much 2008 or 9, it was fairly stable. And even a decrease in dispersion. So that's the good news. The countries, the economies became more homogeneous. Obviously, within the crisis, you have an increase in dispersion. That's something that we have expected, and then a recovery afterwards to the pre-crisis levels. So that's not bad at all. What about public finances? Again, public debt and public deficits. Here it's not such a positive news, but still stability up to the euro area crisis, and then an increase in dispersion, and a return to the pre-crisis levels afterwards. So that's not that bad. Now is when the bad news come into the equation, into the analysis. This is monetary dispersion, including the 4 indicators that I just mentioned before. It is so important that I will devote a slide just for the analysis of this line. Let me just for the minute concentrate on another indicator of dispersion, which is competitiveness. Remember, inflation across the Eurozone, dispersion in inflation, unit labor costs, and the real exchange rate. Here, what is really striking to me is that even before the outbreak of the crisis, competitiveness across member states did come much different, really, very different, even before the outbreak of the crisis. Of course, within the crisis, there was a huge increase in dispersion. We have only mitigated dispersion a little bit since 2010 onwards, and now it's very much stabilized around that level that you can tell in the line, but we haven't really made much progress about it. There's still a lot of dispersion as regards competitiveness across the Eurozone countries. But let me talk a little bit further about monetary dispersion. Remember, by monetary dispersion, I mean the amount of money created by each economy, credit to the private sector, target 2 balances, and the current account balance. This is how monetary dispersion would look like without target 2 imbalances, which is not bad at all. It's really good, actually. As you can tell, a period of stability, very much stable, actually, and even from 2015 onwards, a decrease in dispersion. That's great news for the European Central Bank. But if you add target 2 imbalances into the calculation of dispersion, the situation is the one that I presented to you before. So what about these target 2 balances? What do they show? Well, here we have to make a distinction between different time periods. I'm sorry because this is a bit technical. I'll try to keep it as less technical as I can. Up to 2007, there is no difference between the two. Target 2 imbalances were fairly small. But then you have the global financial crisis years and the euro crisis years, which means a flow of deposits from banks in the periphery of the Eurozone, I'm sorry for using this language, but it's indeed the periphery of the Eurozone, onto banks placed in the core of the Eurozone. That's exactly what target 2 imbalances are reflecting here. And then from 2015 onwards, the ECB, the European Central Bank, started the asset purchase program, which means QE, which is the purchase of government debt issued by those countries in crisis, but not only. And that increased again the deficit position of these countries vis-a-vis the other Eurozone member states. So, if you wish, the price that we had to pay to maintain monetary stability, the upper line, the dotted line, is just to increase the target 2 imbalances, is to incur ourselves in these quantitative easing operations. That was the price we had to pay to maintain the euro, actually, to maintain stability in money growth. So how should we read these figures? As I said, the overall index of dispersion is just the average of the 4 chapters we have calculated, these 12 indicators. There are some caveats you should have in mind. First of all, as you know, the euro has been running for, well, nearly 20 years. That's not enough to make sensible policy implications. As a famous monetary economist, Hugh Rockock, put it in a publication in 2003, he claimed that the US dollar took 150 years to become an optimal currency area. So let's not be so harsh on the euro. It may take some few more decades to become an optimal or pseudo-optimal currency. So here is the overall index of dispersion for the Eurozone, very much dominated by this dispersion in monetary factors that I showed you before. And this is how it would look like just for the original 12 member states. So indeed, by adding more states into the club, the Euro club, we did add more dispersion. That's fairly normal or predictable, and the trends are fairly the same. Let me comment a little bit more on these trends. Let me make a split up of the analysis, the time analysis between the good years and the crisis years. The good years, by the good years I mean the expansionary phase in the cycle, 1989, 2006, or even 7. The good news, as I said before, convergence in the business cycle. Just before the outbreak of the crisis, by 2006, nearly half of the dispersion as it was in 1999 in terms of the cycle. That's the good news. But a steady increase in public finance dispersion, 22% increase by 2006. And indeed monetary dispersion since 2004. And finally, which is even more worrying, competitiveness, dispersion in competitiveness did increase drastically even before the crisis by 125%. So was the monetary union, was the euro ready to face the challenges of a major financial crisis? Well, let alone the global financial crisis and the euro crisis? Not really. It was much more dispersed even before the outbreak of the crisis. So by 2006, overall dispersion, according to our index, doubled. This is an indication of, the euro was not ready really to face the challenges of a big crisis. Obviously, within the crisis, things turned much more difficult for the euro. All indexes show a sharp increase in dispersion, and much more pronounced in competitiveness and in public finances. Indeed, they did. And as I showed you before, target 2 imbalances rocketed. Since 2015, we have contained the increase in dispersion, excluding target 2 imbalances, as I said before, and the plausible determinants of this, may I say, could be the QE program started by the European Central Bank in 2015 up to 2018, and to some extent the implementation of successful internal devaluation policies. The cut in spending in those countries who suffered the most the crisis, so they could become more competitive. That's what is, in our view, what is behind the cut in dispersion, in macroeconomic dispersion in the Eurozone. But still, by 2018, overall dispersion is 2.5 times greater than that in 1999. So we are still very far from the 1999 level of dispersion that, may I remind you, was considered at the time suboptimal. It was not a desirable outcome at all. So we're much worse than in 1999, that's for sure. How about the US dollar? Can we compare these results with a comparable case study, the US dollar? Well, what we did is to apply the same methodology and to collect and to calculate dispersion according to the same or similar indicators. There you have the list. Just for brevity, may I refer to the list, please? But they are very similar to those we collected for the Eurozone. Are they comparable at all? Well, both economies are similar or similarish in size, similar population as well, and the methodology, as I said, that we use is very similar. We just calculated dispersion across the 50 mainland US states plus Hawaii and Washington DC. Again, the same size, similar size, economic size and population, but two main differences that we need to take into account in order to assess differences in the indexes. The US is a fully formed fiscal union, and it does have a meaningful federal budget. So whenever there are states in crisis, let's say, or just people needing support from the federal government, they do get funding from the federal government. They do get it. There is no need to implement a bailout program. It is within the system, within the budget, within the federal budget, that there are automatic transfers from the center to those states in trouble, let's say. And the second thing you need to know is that the US is a fully formed banking union. So it's free for funds to move across states to attend the saving and borrowing needs of the US citizens. That's something that we cannot apply to the Eurozone yet. These are the two major caveats we need to take into account. What about the actual indexes? What do they tell us? Let's start with the cycle synchronicity, business cycle. How similar the 50 states are in terms of the business cycle? Well, they are rather similar. Take a look at the scale of the fluctuation here, starting from 100. It goes from 75 to no more 120. That shows similarity in the business cycle performance. Indeed, the business cycle dispersion increased during the crisis years, but then they returned to the pre-crisis levels, and even better, they are better now. What about public finances? Again, not much to say, very much stable. An increase in dispersion, but then a return to pre-crisis levels afterwards. And finally, what about competitiveness? This is a little bit more concerning, but nothing really wrong. The degree of fluctuation, remember, for the Eurozone is much larger. Here it goes from 75 to 170. So nothing really worrying here. This is monetary dispersion. And this is very interesting. Even before the crisis, what we saw in the data is that there were some states within the US providing much more credit than others. That's the reason why you have this zigzag in the series before the crisis. More credit available in some states as compared to others. But then you see a recovery of dispersion. So states became much more similar after the crisis, and they have indeed resumed pre-crisis levels. So nothing really wrong about it. If we compare both areas, finally, the Eurozone versus the US economy, here you have the overall index of dispersion for the US, and here you have the comparable line for the Eurozone. As you can tell, the scale of dispersion is much larger for the Eurozone. Indeed, you have a deterioration in dispersion before the crisis and then a collapse within the crisis years. We just contained the damage, let's put it that way, and it's very much stagnant. You can tell an upward trend, which means positive news, but it will take a long time to go back to the pre-crisis levels. Whereas in the case of the US, yes, they had dispersion during the crisis years, but they are very much similar to where they were before the crisis. So what this story, we believe, is telling you is that if you look into these two lines, there are two ways to tackle this problem. Indeed, it's very objective that you have a problem here. The Eurozone economies are much more dispersed than those comparable states in the US. And you are still running a single monetary policy that should fit them all. So what can you do? There are two policy options here. One is to deepen the so-called fiscal union project here, and just, yes, to acknowledge dispersion and say, well, the best way to do it is how the US does it, which is to internalize those asymmetries within the system and to make transfers from the center. That means further centralization in Europe, to create a meaningful federal, let's say, budget at the center to assist countries in trouble. That's one option. It's not the option that I like, but that's one option, and it may work. The other option is the much more free market option, which is to trust markets, is to make markets become more flexible, to take the hit of the crisis, to let prices and costs go down if needed be, and then to resume competitiveness afterwards. So it's to deepen supply-side reforms in order to make this dispersion lower and to converge to something much more comparable. So here you have the same picture and different, very radical different options. But what is very important in our opinion is you cannot ignore this situation. Dispersion is really greater in the Eurozone as compared to the US dollar, and we should be doing something about it. Thank you very much.